Imagine waking up to discover that 99% of your wealth has vanished overnight. For an individual, that's a tragedy. For a multi-billion-dollar luxury icon like Porsche, it constitutes a corporate extinction event. Just months ago, Porsche was the gold standard in the automotive world, with margins of 18% and a brand name that commanded instant respect. But today, the numbers tell a terrifying story. Their operating profit has plummeted from 4 billion euros to a mere 40 million. In the high-stakes world of luxury manufacturing, 40 million euros isn't a profit. It's a rounding error. While the world watches Tesla and BYD battle for dominance, the legendary German brand is quietly bleeding out in the background. Porsche is losing everything, from its market share to its very identity, and the most alarming part is that traditional strategies can't save it this time. This isn't just a bad quarter, it's the collapse of a century-old empire. To understand how a brand that survived world wars and global recessions found itself on the brink of irrelevance, we need to look back at 2022. This was the year of the Porsche Miracle. They sold over 300,000 vehicles, generated nearly 7 billion euros in earnings, and executed one of the most successful IPOs in history. Investors were eager to buy in, valuing the company at 75 billion euros. The strategy seemed foolproof. Porsche wasn't just a car company, it was a luxury lifestyle brand. They launched the Taycan, a stunning electric sedan that was supposed to be the thinker's Tesla. It was built better, drove faster, and carried the prestige of Stuttgart. CEO Oliver Blume was hailed as a visionary, promising that by 2030, 80% of Porsches sold would be electric. They aimed to lead the old guard into the new world, leaving everyone else in the dust. But that vision was built on a shaky foundation. The first indication that the electric dream was turning into a nightmare came from the cars themselves. The Taycan, once the darling of the automotive press, began to fail in the hands of real customers. Reliability reports started trickling in and then became a flood. Owners experienced total system blackouts on the highway, red warning lights flashing like a Christmas tree, and software glitches that left the cars bricked in their driveways. Consumer Reports eventually labeled it one of the most unreliable vehicles on the market. Moreover, when the cars did work, they often failed the value test. A base Taycan costs nearly $90,000, but offers a disappointing range that is often outperformed by a Tesla, costing half as much. For a Porsche buyer, performance isn't just about 0 to 60 times, it's about overall competence. When a $190,000 Taycan Turbo S gets outperformed on a road trip by a basic Model S due to charging speeds and range, the prestige of the brand quickly diminishes. While the mechanical issues were concerning, the situation in China was catastrophic. For over a decade, China had been Porsche's cash cow, accounting for a third of their global sales. Young, wealthy Chinese entrepreneurs loved the status that a Cayenne or a Panamera provided. However, the Chinese market evolved faster than Porsche could react. Suddenly, the German engineering that Porsche had relied on for 80 years held little appeal for a 35-year-old tech millionaire in Shanghai. They weren't interested in Nürburgring lap times or the fragrance of fine leather. They cared about AI integration, autonomous driving, and smartphone connectivity. In this new landscape, Porsche wasn't just behind, they were invisible. Enter the local competition. Brands like BYD, NIO, and especially Xiaomi turned the industry upside down. When Xiaomi, a phone company, released its first car, the SU7, it not only competed with Porsche, it mocked them. The SU7 was faster, smarter, and technologically superior to the Taycan at a fraction of the cost, even breaking the Taycan's lap record in Shanghai. The message to Chinese buyers was clear. Why pay 3 times more for a legacy brand when you can have the future today? Porsche's sales in China didn't just dip, they imploded, falling nearly 30% in a single year. In a desperate move to save itself, Porsche did the unthinkable. It offered massive discounts, slashing prices by 35% just to move inventory. In the luxury world, heavy discounting is a death knell. It undermines the resale value for existing owners and signals to the market that your product is no longer exclusive. Porsche had broken the first rule of luxury, and there was no going back. As China's economy declined, the company's internal structure began to unravel. In early 2025, a wave of high-level firings indicated a civil war within the boardroom. The CFO and the head of sales were reportedly dismissed after a series of public disagreements with the CEO over the electric vehicle strategy. The watertight plan laid out in 2022 was now being questioned by those tasked with executing it. Meanwhile, Porsche's supply chain was collapsing. The company had invested heavily in a partnership with the Swedish battery giant Northvolt, which was supposed to power its next generation of electric sports cars. However, in late 2024, Northvolt filed for bankruptcy. This setback was not just a minor delay, it created a significant gap in Porsche's future lineup. The electric replacements for the 718 Boxster and Cayman, cars that were meant to be the heart of the brand, were delayed by years. Consequently, Porsche was left with an aging lineup of gasoline cars it was trying to phase out, but with electric models that weren't ready to take their place. By the end of 2025, the financial reality was undeniable. Porsche's once mighty 18% profit margins had dwindled to near zero. The company that used to generate significant profits was now barely breaking even on every car sold. In a leaked letter to nearly 40,000 employees, CEO Oliver Bloom finally removed the corporate veil. He acknowledged that the business model no longer functioned in what he termed the post-Trump New China world. He announced nearly 4,000 job cuts and a permanent downsizing of the company. Porsche was no longer aiming to produce 300,000 cars a year. Instead, they were cutting production by 20% and reverting to a smaller, more niche volume. This shift was not a strategic pivot, it was a retreat. The tragedy of Porsche is that they followed the advice of consultants and politicians. They went all in on electric vehicles, investing billions in platforms, software, and battery plants. However, in their rush to embrace the future, they lost sight of why people bought Porsches in the first place. A Porsche is an emotional purchase. It symbolizes a reward for a lifetime of hard work and embodies the soul of a machine. When you strip away the engine and replace it with a battery and software that feels outdated compared to a Chinese smartphone, you lose the soul that justifies the six-figure price tag. Traditional buyers are frustrated because the beloved gasoline cars are being phased out, while new tech-savvy customers are ignoring them due to inadequacies in Porsche's technology. They find themselves in a no-man's land between being a heritage sports car brand and a cutting-edge tech company, failing at both. While Porsche is shrinking, its competitors are thriving. BMW has successfully increased its electric sales by maintaining flexibility, offering gasoline, hybrid, and electric versions of the same models. Tesla continues to dominate the luxury EV segment through sheer scale and superior software. Meanwhile, Chinese brands are gaining strength, beginning to export their high-tech, low-cost vehicles to the world. Porsche now faces a future in which it is no longer a leader in the industry, but a boutique manufacturer struggling to survive on the remnants of a market it once dominated. Yet there is a deeper, more structural issue that the board in Stuttgart is reluctant to acknowledge: the 911 paradox. For decades, the 911 has been the golden goose, the car that allowed Porsche to charge six-figure prices for what is essentially a refined version of the Beetle. It is the soul of the company. However, in their haste to electrify their lineup, Porsche has inadvertently turned their crown jewel into a museum piece. By announcing that the 911 would be the last man standing for internal combustion engines, they signaled to their customers that the future is unexciting and that the brand's soul lies in the past. This has created a significant psychological divide. If you are a lifelong Porsche enthusiast, you now view the electric Macan or Taycan not as progress, but as a compromise forced upon you by a company that doesn't genuinely want to produce them. You cannot promote the future when your own marketing department is quietly suggesting that the real Porsches are the ones with an exhaust note. This has alienated their purest clientele without succeeding in winning over the tech-savvy Gen Z buyers who perceive Porsche as just another legacy brand. The software wall represents a significant challenge in the corporate world, highlighting the vast difference between mechanical engineering and software development. Porsche's engineers are renowned for their expertise in precision mechanics, such as perfecting suspension geometry and optimizing lap times. However, when it comes to coding, they lag decades behind. Today, a luxury car is not merely a machine with a computer inside. It is essentially a computer on wheels. When a Chinese consumer steps into a brand like Xiaomi or NIO, they experience a seamless, lightning-fast interface akin to the latest iPhone. In contrast, when they enter a Porsche, they are confronted with a clunky, lagging system that resembles a BlackBerry from 2011. You cannot justify Porsche prices for a digital experience that feels like a budget tablet. This issue cannot be resolved with a simple software update. It demands a complete cultural shift that many century-old German companies cannot achieve. They are attempting to win a software battle with mechanical solutions, and while they struggle to fix their infotainment systems, competitors are already 3 generations ahead, integrating AI and autonomous features that render Porsche's mechanical precision outdated. The announcement that Dr. Michael Steiner will succeed Oliver Bloom as CEO in 2026 signals a final acknowledgement of the previous era's shortcomings. The new leadership faces an immense challenge. They must improve the software, secure new battery partners, rebuild their reputation in China, and persuade their loyal customers that a Porsche without a flat-six engine is still a true Porsche. They must accomplish all of this while profits are at a historic low and investors are seeking to exit. The luxury car market is evolving into a winner-take-all environment, and currently, Porsche is on the defensive with a struggling team. Porsche's decline offers a crucial lesson for the corporate world. Brand prestige does not protect against technological irrelevance. Even the most famous logo can't compensate for a product that fails to meet customer needs better than the competition's. Porsche believed it could dictate the future to their customers, relying on their history to shield it from the harsh reality of the shift towards software-defined vehicles. They were mistaken. They staked their future on a specific vision, and when that time came, the reality was vastly different from their expectations. As we look toward the next few years, the question is not whether Porsche will survive. They likely will, perhaps as a smaller, more exclusive version of their former selves. The real question is whether they will ever be Porsche again. Can they recapture the magic that made their cars the stuff of bedroom posters for generations? Or are we witnessing the final painful chapter of a legendary name destined to become just another asset in a massive corporate portfolio? The staggering 99% profit collapse is a wake-up call that the rest of the industry should heed. If it can happen to Porsche, it can happen to anyone. The corporate world is moving faster than ever, and those who stop to admire their own heritage are usually the first to be left behind. In the end, Porsche's story serves as a reminder that in business, you are only as good as your next move. They became complacent during the boom years of 2021 and 2022, assuming the money would never stop flowing. They ignored warnings from China and dismissed the threat posed by Silicon Valley software. Now the bill has come due. The road ahead for Porsche is steep, winding, and full of obstacles. For the first time in a generation, the driver of the world's most famous sports car brand is no longer in control of the vehicle. They are just trying to keep it on the road. As profit numbers continue to slide, the world is starting to discuss what happens when a legend loses everything. The engine has stalled, the tank is empty, and for Porsche, the race of a lifetime has turned into a fight for survival.